The stock market crash of 2025. Are you prepared? With inflation beginning to creep its ugly head back up, the new Trump tariff plan incoming, which many think will backfire, and a 100-year trendline which signals the next big crash is imminent, it's no wonder people are starting to get a bit anxious. But then on the flip side, there's also a number of good reasons why the stock market and crypto could have another excellent year. So the question is what to do. And so in this video, we're going to cover firstly the bear case, the reasons why we could be headed for a major crash in stocks and crypto in 2025. Then we'll look at the bull case, the reasons why stocks and crypto could have another amazing year. And then most important, I'm going to show how to prepare so it doesn't matter which way the markets go, you can win in either direction. And as a bonus, we'll take a look at how arguably the world's greatest investor, Warren Buffett, plays the game. So the goal of this video is to give you the insights and the strategies so you never fear a market crash ever again. Okay, so first up, why are more and more people calling for an imminent stock market crash? Well, let's take a look. So we are starting off with the bear case. Why do the bears feel so bearish? And this is the Buffett indicator. As Warren Buffett famously said, it's a great way to see whether the market is overvalued or undervalued. And it divides the stock market by GDP, so the economy. Now, if it's a low reading, it means that the economy is very strong relative to the stock market, which is particularly cheap. And if the reading is super high, it can mean either the economy is very weak or stocks are very overvalued in comparison. Now, this goes back to the 1950s, and historically, the reading is round about the 50% mark. This was the dot-com crash, where it got to 162%. You'd have to say very overvalued, and this did cause a crash. And the worrying sign is that over the past 10 years, we've got to these crazy levels, over 200%. This was the one before the last bear market, and then prices have shot back up, and we're very close to this 200% mark again. So the bears would be correct saying the Buffett indicator is saying stocks are very overvalued. Number two, and this has to do with the bond market and the yield curve. So there is an enormous amount of money in the bond market, and typically a healthy economy, you would have a nice yield curve that looks like this. It would start off very small and pick up and then rise up. That's a nice healthy yield curve. So if you're lending your money to the government for the short term, 1 month, 3 months, then you should only get a small yield. However, if you're going to lock your money away for 30 years, then you should be compensated for it and get a nice 5%. The problem is, for the last couple of years, the yield curve has been inverted, meaning you were getting more money, loaning your money for the short term, and it went down for the long term. So this says that the economy is pretty much broken. Now, most recently, this has started to correct, and when the yield curve uninverts, historically, this does lead to a recession. So another good reason why the bears are bearish, and with the yield curve pretty much flat right now, this does not signal a healthy economy. Number three has to do with inflation. So yes, inflation was a lot higher, and we've been making good ground, and inflation had been coming down. The problem is, over the last few months, inflation has been ticking back up. And the last few months, inflation has been a bit higher, a bit higher, a bit higher. And obviously for the economy, low inflation is better and high inflation is bad. Number 4 has to do with the S&P 500, and oftentimes when we do get a massive stock market crash, normally before it there's a massive run-up. So this is the S&P 500 and this is what's happened in the last year. So on average, the S&P 500 goes up about 10% a year. However, last year, the year just finished, 2024, it went up almost 25%, way above the average. So this is a bit of a bubble warning sign. And then if you look at 2023 as well, it did almost the same. So that's 50% in just the past 2 years. Certainly a bit of a warning sign. And then finally, how about this for a 100-year trend line? So this was the greatest stock market crash in history in 1929. And if we take a reading here, it runs all the way through, kissing the market here, which led to the dot-com crash. And then markets have just tagged this line once again. So from a technical analysis point of view, this signals that another market drop is due. So as you can see, these are just 5 good reasons as to why a big stock market crash could happen in 2025. But what makes things very confusing is that there's also a solid bull case as well. And the first has to do with Donald Trump. There's nothing to say that with Donald Trump being an amazing businessman, the stock market and the economy could go on an absolute tear. He now has experience as a president, he's putting a good team in place, and his new tariffs and renegotiations with all the other countries could lead to a boom. The point is that it's a big unknown. Trump's second term could be enormously bullish. Number 2 has to do with technological revolutions. So normally after a massive breakthrough in technology, you get a huge boom time in the economy. This is what happened with the steam engine. Same thing when railways first came in. What about this one here, where the telephone, the car, and electricity came in short order, causing a massive boom time in the roaring 20s. This was the biggest stock market crash in history. We then had the rise of computers, the rise of the internet. But then as of right now, we've got huge breakthroughs coming with energy, with AI. Just AI alone could completely transform all businesses. We have robotics. Many people are saying there's going to be more robots than people walking around in the not too distant future. Breakthroughs in genomics, and obviously with what's going on with Bitcoin and blockchain technology, another financial revolution. Add all these together, and it's a very good reason why 2025 could be a huge year. And then finally, has to do with the global monetary liquidity. So most recently, this has been going through cycles of quantitative easing, QE, where money gets pumped into the economy, followed by quantitative tightening, where money gets sucked out of the economy. And with the last bear market, money and Jerome Powell was actually sucking money out of the economy. They're still doing quantitative tightening. So 2025 should be the return of QE, which means this is incredibly bullish for risk assets, which says to me this year could be a boom year, and it's more likely that at the end of the year, November, December, and then it'll be 2026, that is most likely to have a big correction. So there are solid reasons why 2025 could also be an amazing year. But the most important part of this entire video is, how do you win either way? Well, the first step is understanding these important facts. Number 1, It's that corrections happen on average every single year. And a correction is a drop in the market between 10 and 20%. So these drops of 10%, of 10%, of 10%, of 10%, they happen every single year on average. So in the stock market right now, the S&P and the Nasdaq are only down about 5% and people are already freaking out. Second, it's that bear markets happen on average every 5 years, and a bear market is a drop of over 20%. Number 3, crashes, the ones that people really fear of over 50%, are really not that common. In fact, there's only been 3 for the last 100 years. We have the 1929 crash, the dot-com crash, and the great 2008 financial crisis. Number 4, we have to remember that the markets have always gone on to recover and set new highs. So most of the people watching this will be in the US stock market or the UK market, and we have to remember, even in the absolute worst crashes of over 50%, the markets have always recovered. So these are the things to keep them front of mind as they're very important, and now we can talk about strategies. So the first strategy is probably something you have heard about before. It's very, very simple and extremely effective. And it's how to never fear crashes ever again. It's dollar cost averaging. And this simply means instead of just putting all your money in the stock market and then waiting 10, 20, 30 years, you actually do this at a regular basis. This could be weekly, it could be monthly, but as the market is moving, you just keep making smaller purchases. You make purchases on the way up, you can make purchases on the way down, and then overall you will get an average. So it's one thing hearing about this, let's see this in action against the worst stock market crash in history. So jumping over, winding all the way back to 1929, and this is the Dow Jones, the greatest stock market crash in history, where it crashed over 90%. Now, what you'll hear on the news and what the fearmongers like to say is that crashes like this, it would take you 23 years to recover from. So clearly something that must be feared. And you might hear about lost decades. Well, let me now tell you the things that people don't mention. Firstly, this is only true if you put all of your money in at the absolute peak. And for the vast majority of people, this won't be the case. In fact, over the previous years or decades, you'd be buying down here. Remember, it's only the last couple of years where the market goes vertical. So yes, if you bought really near the top or at the absolute peak, yes, this is true. However, second, the actual crash is much, much shorter. So this one had finished after 4 years. And as we'll see with other crashes, it could be over within a year, it could be over within 2 years. This was the worst one in history, and it's still just 4 years. Very different to 23 years. Now, when it comes to dollar cost averaging, let's say you are buying all here, then everything is good. Even up to here was pretty much good. The small buys that you made here and on the initial sell, these are the only ones that are a bit in trouble. If you were to buy here, or buy here, or buy here, or buy here, buy here, 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 these are actually excellent buys. And if we pick things up from just here, then all of these purchases are excellent buys, and you're making money the entire way, all the way back 23 years. So by dollar cost averaging, this is not your reality. Same thing, we have the big dot-com crash and the great 2008 financial crisis with the S&P 500. The fearmongers will say, oh, these were lost decades. But as we now know, only if you put your entire stack in at the absolute peak. If you are buying all the way up here, you are absolutely fine. If you are buying into the crash, these are excellent buys. Buying all out of the crash, excellent buys. Remember, the most scary, biggest, worst crashes in history give you the very best buying opportunities. That's a very important point. Then all of these buys, all the way back up, you're making money. It makes the worst stock market crashes in history not seem that bad, right? Now, finally, for all the people that say, yes, but I don't have any money to invest in these crashes. Well, this brings us on to the final strategy. The number one greatest investment decision you will make, and that is your asset allocation. Now, keeping things super simple, if you were to keep 100% of your money in cash, as you're super scared, super fearful, then if the stock market goes up, which it has done for 100 years, then you miss out. You do not win on the upside. And in fact, inflation is stealing a little bit more of your pie every single year. However, if there is a stock market crash, then you do have money to invest. Conversely, if you are super aggressive and too greedy and you have 100% of your portfolio in stocks, then as the market's going up, you are making money, happy days. However, in a crash, you can't dollar cost average because you don't have any money. So it's not so good on the downside. So the solution, quite simply, is to have a good split of money invested in the market and money in cash. And this way, if the market goes up, you're making money. If there is a big crash, you have money to invest. And remember, the very best buys are in the worst crashes. And this is the strategy of how you win in either direction. Now, for all the people that say this is just overly simplified, and the average investor is going to have a much more complex portfolio than this, well, let me finish this video by showing you the portfolio of arguably the world's greatest investor. And so, if that was oversimplified, what does Warren Buffett's Berkshire Hathaway portfolio look like as of right now in 2025? Well, lo and behold, it's almost exactly what we saw in the last screen. As of right now, Warren Buffett is 55% in cash and cash equivalents and 45% invested in the stock market. So amazingly, this is pretty much exactly how Warren Buffett is investing right now. Now, when we say 55% in cash, he's actually got a cash position of $325 billion, which is pretty crazy to think about. And he doesn't necessarily keep it in cash. He keeps it in cash equivalents, being short-term government bonds, which right now pay about 4%. However, for the average person watching this, even money in a money market fund or even in a high street bank are giving close to 4%. So this is giving Warren Buffett an amazing $13 billion every single year just on his cash position. So here's the point of the video. If the stock market keeps going up, Warren Buffett is making an enormous amount of money and an enormous amount of money on his cash position. If there is a big market crash of over 20%, you'll probably see him invest a segment. If it's over 30%, he'll invest another big segment. If it's over 50%, he'll largely be going close to all in, and then he'll be making a ridiculous amount of money on the upside. And the great thing is that for the average person watching this is very easy to replicate. The stocks could simply be an S&P 500 index fund, and cash right now could just be kept in a high interest savings account. Is there going to be a big stock market crash in 2025? Well, the problem is that there's plenty of data for the bears to be bearish about. However, what makes this more difficult is that there's also many reasons why the markets could have another excellent year. And so ultimately, this is why the best thing to do is have a plan so you can win in either direction. If the market goes up, you can win. And if there is a big market crash, then this gives the very best buying opportunities and also the fastest gains that follow. Remember, although you hear about market crashes all the time, 50% crashes are actually very, very rare. For what it's worth, I believe 2025 is probably going to be another good year in the markets, and then due to the global liquidity cycle, I think it's more likely that a major downturn will come in 2026. However, let me just finish by saying if you are close to retirement and don't have the luxury of time to recover, then de-risking your portfolio is probably a good thing to do. So there you are, guys. Hope you enjoyed. Now, please feel free to share this with a friend who may also need this vital information, and do check in with a professional financial advisor if you're going to make any large investment decisions. If you do have any burning questions that must get answered, then use SuperThanks below. But just remember, to get rid of 100% of the comment spam and trading bots that plague YouTube comments, we are trying out the new SuperThanks Commenting system. So to get your question or comment read and replied to, or just to say thanks, then use SuperThanks below. And for now, just to say, if you did enjoy anything in the video, then drop a like, and a big thank you to everyone who does, and I'll see you in the next video. Bye for now.